Two traders watch the same chart. One smiles because the spot price is up. The other doesn't even look at the chart. He looks at a delivery schedule, a vault report, and the words back order and allocation. In 2026, that second trader is the one who sleeps. Right now, the market is split into two worlds that no longer agree with each other. One world is digital, liquid, effortless, click, buy, sell, repeat. The other world is physical, bars, coins, wire, metal, inventories, refinery throughput, shipping lanes, vault keys, and waiting lists. And here's the uncomfortable truth. When a physical deficit shows up, the paper world doesn't set the price anymore. The paper world sets the story. The physical world sets the bill. So today I'm going to show you 5 assets that survived the physical deficit. Assets that didn't just hold value, but gained a physical premium because people wanted the thing, not the ticker. Then I'll show you which paper gold contracts went to zero. Not as a dramatic headline, but as a functional event. Confidence evaporated, liquidity disappeared, and the contract became a promise you couldn't convert. Let me frame the whole problem in one line. If you can't take delivery, you don't own it. In the last 24 to 48 hours, the gap has widened again. PaperSpot can print a number, but the real world asks a different question. Can you actually get it today? In many markets, paper gold can sit near $4,600, while a 1-ounce gold eagle costs closer to $4,150 once you include availability, dealer risk buffers, premiums, and the rush order reality. That spread is not noise. That spread is a signal. And it isn't just gold. It's the entire Great Divergence, the moment where claims multiply faster than inventory. Estimates floating around the market put paper claims on gold near 100.1. Think about that. For every 1 ounce that exists in a vault, 100 different people believe they own an ounce through accounts, swaps, futures exposure, ETF shares, structured notes, and allocated sounding statements. When times are calm, that machine runs. When a physical deficit hits, the machine coughs. Then it starts choosing who gets metal and who gets a cash receipt. You need to understand the 2 clocks in this market. The paper clock measures price. The warehouse clock measures availability. And when the warehouse clock runs out, paper price becomes a suggestion. Now, 5 assets that survived. Asset 1, physical gold, bars and coins you can hold. Gold survived because it is the final settlement asset when trust gets thinner. But in 2026, the key detail is this. The market is not rewarding gold exposure. It's rewarding gold access. That's why physical premiums are appearing and staying sticky, especially across Asia, where the cost above spot can run $50 to $100 per ounce, depending on product, weight, and availability. This is the part people miss. A physical premium is the market voting with its wallet. It's saying, I don't want a promise, I want the object. So if you own physical, your job is simple and boring. Authenticity, custody, and patience. Authenticity means buying recognizable products from reputable sources, verifying packaging, weight, and dimensions, and never ignoring the small details that counterfeiters usually get wrong. Custody means knowing where it is, who can touch it, and what happens if you need it fast. Patience means accepting that physical is not meant to be flipped every Tuesday. It is meant to exist when other things fail. If you do not own physical and you want to convert, start with a question. Is my account allocated with specific bars assigned to me, or is it a pool where I'm just a line item? Because those two are not the same asset. Asset 2, silver bullion, the metal that industry consumes. Silver survived because it sits at a brutal intersection. It is money to investors and fuel to industry. AI infrastructure, data centers, power systems, sensors, and solar manufacturing don't run on exposure. They run on ounces. And when deficits stack for years, inventories become the story. This month, inventories at major exchanges have been grinding toward multi-decade lows, and silver has started behaving like a strategic input instead of a cheap cousin of gold. The premium isn't just about fear, it's about the physical bottleneck. You can't build tomorrow's tech with a spreadsheet. For silver, the survival play is almost boring. Stick to recognizable bars and coins, avoid weird products with giant spreads, plan storage like you plan insurance. And here's the most common mistake. Assuming a physical shortage can be replaced with a paper substitute at the same price. In a deficit, you can't. The same exposure does not equal the same outcome. Asset 3, grade of copper, the metal that refuses to be faked. Copper survived because electrification is not a slogan. It's a wiring diagram. EVs, grids, transformers, charging networks, heat pumps, and modern construction all eat copper. And the higher the energy transition accelerates, the more good copper matters. Not all copper is created equal. Grade A deliverable material is what the real system demands. In 2026, physical copper has been showing its teeth. inventories falling, delivery wait times stretching, and the market insisting on real units, not synthetic bets. Reports have pointed to meaningful inventory draws over the last 6 months, and when warehouse stacks thin out, price becomes secondary to access. Now, for most retail investors, you're not buying a pallet of copper cathodes and storing it in your garage. I get that. The point is, the lesson copper teaches, some commodities are too essential to remain purely financial. When the underlying is scarce, paper games lose control. If you want copper exposure, be honest about what you're actually buying. Producers are equities with operational risk. ETFs are wrappers that may or may not behave like metal under stress. The physical market is the physical market. Don't confuse them. Asset 4, truly backed digital gold, digital interface, physical settlement. This one surprises people. Digital gold survived in places where the digital part is only the interface, not the asset. In other words, an app that represents audited vaulted metal with clear redemption rules can thrive during a deficit because it makes real ownership easier for normal people. Why did transaction volumes jump in late 2025 in several markets? Because people wanted something simpler than futures, but more real than a vague brokerage claim. When the structure is transparent, audits, bar reconciliation, clear fees, and clear redemption, digital access can become a bridge to physical reality. But you must read the fine print like your future depends on it, because it might. Ask these questions. Do you have allocated metal or a general pool claim? Can you redeem into coins or bars, and what are the minimums? Are audits independent and are reports current? What happens during high demand periods? Do redemptions pause? If you can't answer those, it's not digital gold. It's digital hope. Asset 5, rare investment grade coins. Scarcity with 2 engines. These survive because they carry a double hedge. The first hedge is the metal. The second hedge is the rarity. A coin with numismatic demand cannot be mass-produced on a delivery schedule. It doesn't matter how many contracts trade in a day. You cannot print a high-grade historical coin because an ETF needs inventory. That's why auction prices can go vertical when fear rises. You're not just buying ounces, you're buying history plus ounces. But be careful. This market rewards expertise. Condition, grading, authenticity, and liquidity matter. If you don't have that expertise, partner with it. The advantage is real. The learning curve is also real. So those are the survivors: physical gold, silver bullion, grade A copper, truly backed digital gold, and rare investment grade coins. Now let's talk about the contracts that went to zero. In commodities, zero rarely means the screen prints 0.0. Zero means the contract stops functioning as the thing it advertised. It becomes a claim you can't convert, a position you can't roll without punishment, or an instrument whose liquidity vanishes the moment you need it most. 3 structures have been facing functional zero events. Contract Type 1, unallocated pool accounts. This is the polite version of, we owe you metal, but you don't have specific metal. In calm periods, unallocated accounts feel convenient. In a deficit, they feel like a trap door. Here's what happens during a run. Investors request delivery, the institution offers delays, cash settlement, or alternate products, and the customer realizes the account is not a vault key, it's a balance sheet entry. And the ugly reality is legal, not emotional. In many setups, you are an unsecured creditor. If the institution freezes, restructures, or fails, you don't get your gold. You get in line. Functional zero happens when the promise is still printed, but redemption is effectively dead. Red flags: best effort delivery. No guarantee of specific bars. Cash settlement at our discretion. Delivery may be delayed due to market conditions. Those lines are a quiet confession. Contract Type 2. Highly leveraged futures during expiry washouts. Futures are powerful tools until the tender period arrives and the market asks who can actually pay for delivery. During stress, the price can move against you, and the exchange can change the rules of survival. Higher margin, tighter windows, and faster liquidation. In January 2026, the pattern has been familiar. Traders holding long paper positions were forced to close because they lacked the funds, logistics, or intent to take delivery during the tender period. You can be right on direction and still get crushed by structure. When margin climbs, time collapses, and the window closes, the position becomes a liquidation event instead of a wealth event. That's functional zero. You owned metal exposure, but the contract owned you. Contract Type 3. Synthetically backed ETFs, swaps instead of bars. Not every ETF is the same. Some are simple, bars in a vault, clear custody, boring transparency. Others are engineered, swaps, rolling derivatives, counterparties, and paperwork designed to mimic a metal that may not be fully there. During a deficit, these structures can decouple. NAV can wobble, liquidity can thin, spreads can widen, and the fund can face a slow-motion bank run of selling pressure. The zero moment is when the ETF stops behaving like the asset and starts behaving like a stressed financial product. That's when you discover you didn't buy metal, you bought a mechanism. This is why the physical premium matters. It is the market admitting that paper and metal are not identical. So what do you do with this? You audit your ownership like an engineer, not like a gambler. Here is your checklist: simple, practical, and ruthless. Step 1. Identify whether you own the asset or a claim. Ask one question. If I request delivery, what happens next? If the answer is vague, delayed, conditional, or full of subject to, you own a claim. Step 2. Stress test the custody chain. Who holds it? Where is it? Is it allocated to you? Is there an independent audit? Can you see bar lists, serials, or reconciliation? What is the redemption window? If the chain is opaque, the asset is not yours in the way you think. Step 3. Match the vehicle to the job. If it's a trade, paper can be fine. If it's protection, paper is a costume. Protection needs redemption. Now, the final piece. Why this divergence is happening at all. When serious buyers decide the priority is certainty, they stop buying paper safety. They buy settlement, they buy bars and coins, they buy the thing that doesn't require permission to exist. That's why physical demand stays relentless even when the screen price looks high. It isn't about cheap, it's about available. Some forecasts have gold reaching $5,000 by Q4 2026. Maybe it happens, maybe it overshoots, maybe it pauses, but that number is less important than the mechanism behind it. When the world wants the metal, paper positioning becomes a footnote and physical flow becomes the headline. Let me make the zero concept feel real with a simple scene. Imagine you wake up to a headline: record demand. You open your brokerage app, your gold position is green. You feel relief. Then you decide to do the one thing that turns exposure into ownership. You request delivery. That's when the clock changes. First, you're told there's a processing delay. Then you're offered a cash settlement at current market value, as if that solves the problem. Then the spread widens, the quote changes, and the language gets softer. We'll do our best. At that moment, your contract hasn't printed 0.0, but it has lost the one feature you bought it for: conversion. That is functional zero. And it can happen fast, because liquidity is a fragile social agreement. In calm markets, everyone assumes someone else will take the other side. In stress, everyone runs for the exit at the same time, and you discover which doors are real doors and which doors are painted on the wall. So here are 5 quick tests you can run this week. No spreadsheets required. Test 1. Can you name the custodian and the jurisdiction? Test 2. Can you describe the redemption process in one sentence with a time frame? Test 3. Do you have a serial number, a bar list, or a specific allocation record? Test 4. Does the contract allow the issuer to settle in cash by choice? Test 5. If the platform froze withdrawals for 30 days, would your asset still protect you? If any of these answers are, "I'm not sure," treat it as a warning light. Now, a tactical move that keeps you calm. Split your thinking into 2 buckets. Bucket A is for trading: liquid, fast, imperfect, flexible. Bucket B is for survival: boring, verified, redeemable, stored. The mistake is putting survival in bucket A because it's convenient. Because the moment the deficit becomes visible, convenience becomes expensive. So if you're building bucket B, do it in steps. Start small, confirm the process, verify authenticity, learn storage, only then scale. The goal is not to panic buy. The goal is to be the person who doesn't need to panic. And before we close, a quick reminder: this is not financial advice. It's a framework. Your job is to understand what you own, why you own it, and whether it still does the job you hired it to do. Because in a physical deficit, price is not a number. Price is availability. If you want exposure, you can rent it. If you want ownership, you have to secure it. And in 2026, the market is finally teaching that difference the hard way.